Staying sharp on the tech market, especially, individual stocks, it could feel like trying to drink from a fire hose sometimes.
Absolutely. So much noise, so many headlines.
Exactly, and figuring out what really matters for your portfolio, that's the challenge. But that's why we're here.
Right.
Today we're doing a deep dive into ServiceNow Inc., ticker's NNOW, a company that's, well, making some serious waves. Our mission is simple. Cut through that noise, get straight to the core insights, all based on the source materials we've gathered.
And it's quite the collection we have. We've pulled together the latest investor analyses, the most recent financial reports, key news updates, everything current as of July 29, 2025.
Okay.
And ServiceNow, it's a really fascinating case study right now because, it sits right at that intersection of, well, AI hype and the whole digital transformation push.
Yeah, two massive trends.
Exactly. They're positioned right where the action is happening in enterprise tech.
Okay, so let's pull back the curtain then. For anyone who maybe isn't totally immersed in enterprise software, what exactly is ServiceNow? What problem are they actually solving?
Right. So at its core, ServiceNow is really a pioneer in cloud-based digital workflows. Think of them as architects of efficiency for big companies. Founded way back in 2004 by Fred Luddy. Their slogan kind of sums it up. The intelligent platform for digital workflows. It's all about taking those internal processes, IT, HR, customer service, you name it, that are often clunky or disconnected, and making them smooth, automated, and, well, intelligent, basically changing how work gets done inside a company.
It sounds like they've really moved beyond just IT, though, which is probably where a lot of people first heard of them.
Oh, definitely. You're spot on. Their foundation, and still the biggest slice of their revenue, is IT workflows. That covers things like ITSM, IT service management, ICOM, ITPM.
Right, the classic IT stuff.
Exactly. But they've expanded massively. Now they have employee workflows. That's for HR service delivery, HRSD, think onboarding, payroll questions, that sort of thing.
Makes sense.
Then there's customer workflows for customer service management, CSM, making those interactions way more efficient.
Right.
And maybe the most exciting part is their creator workflows. That includes their app engine, which lets companies build custom apps right on the ServiceNow platform, tailoring it to their specific needs.
Wow, okay.
And crucially, weaving through all of this is AI and generative AI, their Now Assist feature. That's designed to boost productivity across all these workflows, making everything smarter, faster.
Now, enterprise software is a crowded space. I mean, really crowded. What makes ServiceNow stand out? What's their secret sauce, if you will?
Yeah, it's a good question. It really boils down to a few key things. First, that single cloud platform, that's a huge competitive advantage.
Also.
Well, instead of stitching together different tools, ServiceNow offers one unified system that breaks down data silos, It gets departments talking to each other, turns a fragmented company into more of a cohesive unit.
Okay, that's a good.
Second, their customer base. It's incredibly strong. Over 80% of the Fortune 500 use them. But here's a really interesting part. A lot of those big guys started small with ServiceNow.
Oh, really?
Yeah, maybe just one IT workflow. Then they expanded. It shows how sticky the platform is and how well they execute that land and expand model. High retention is key.
Right, land and expand.
And finally, just their continuous innovation, especially how quickly they're integrating AI and generative AI. They're not just keeping up, they're actively trying to shape what digital work looks like.
That's a great overview of what they do and their strengths. But, for American investors listening, it always comes back to the numbers. How's their financial health looking? What did the latest results tell us?
Okay, financials. The Q2 2025 results announced July 23rd, 24th. They were basically a textbook beat and raise, exactly what investors want to see from a growth company like this.
Beat and raise. Good signs.
Definitely. Total revenue hit $3.22 billion. That's up a solid 22.5% year over year, and it easily beat the analyst estimate of around $3.12 billion.
And subscription revenue, that's the core.
That's the core, $3.13 billion, also up 22.5% year over year. Very strong, consistent growth there.
Okay, top line looks good. What about profitability? Did that hold up?
It did. Their non-GAAP EPS, that's earnings per share adjusted, giving you a clearer operational picture, came in at $4.09. The estimate was $3.57, so a significant beat.
Nice.
And their non-GAAP operating margin was healthy, too, at 29.5%. But for me, especially with a SaaS company like ServiceNow, if you really want to understand the bigger picture, you have to look at RPO.
RPO, remaining performance obligations.
Exactly. And specifically, CRPO, current RPO.
Why are those RPO numbers so critical for a business like this?
Because they give you fantastic visibility into future revenue. It's contracted business that's already locked in, just waiting to be recognized.
Okay, so it's predictable revenue.
Highly predictable. Their CRPO, that's revenue expected in the next 12 months, grew 24.5% year over year to $10.92 billion. Think about that. Almost $11 billion already contracted for the next year.
Wow.
And total RPO, including longer-term deals, jumped 29% to $23.9 billion. These aren't just numbers. They show a massive backlog and the predictability of future growth.
That must give management confidence.
It absolutely does. That strength is why they raised their full-year 2025 subscription revenue guidance. They bumped it up by $125 million, now expecting between $12.775 billion and $12.795 billion. That's about 20% year-over-year growth. Shows real confidence in their momentum.
That's a strong signal. And you mentioned AI earlier.
Yeah.
Is management explicitly linking the strong performance and guidance to AI demand?
They are, very explicitly. It's a critical point.
Yeah.
They directly credited AI demand as a key driver, and they backed it up with some concrete examples.
Like what?
Well, they noted really impressive growth in their largest deals. Customers with over $20 million in annual contract value, ACV, that cohort grew by more than 30% year over year.
30%.
Yeah. And they also signed 89 new deals worth over $1 million in ACV just in Q2.
Okay, so it's not just hype. Companies are writing big checks for their AI solutions.
Exactly. It shows significant, large-scale investment happening, and ServiceNow is clearly benefiting because they're effectively monetizing features like Now Assist. And digging a bit deeper on AI, that Now Assist offering is clearly performing well, maybe even ahead of schedule. They seem firmly on track for that ambitious goal, $1 billion in AI ACV by 2026.
$1 billion in AI revenue by 2026, that's ambitious.
It is, but the momentum seems there. And at their big conference, Knowledge 2025, they rolled out more AI stuff, the ServiceNow AI platform, something called the AI Control Tower.
AI Control Tower, what's that?
Think of it like a dashboard. Lets companies monitor AI agent performance, track ROI, manage everything centrally across the enterprise, and also AI Agent Fabric, which helps connect AI agents across different workflows.
Makes sense. Integrating it all.
Right. And a really big strategic move was the partnership they announced with NVIDIA.
Ah, NVIDIA. Everyone's favorite AI partner these days.
Pretty much. They're co-developing a new reasoning model, April Nematron 15B. The goal is to make the platform even better at handling complex workflows, reasoning through problems faster.
That NVIDIA partnership and the clear monetization path definitely underscore their AI commitment. So how does ServiceNow's performance fit into the bigger picture, the whole enterprise software, digital transformation landscape? Are those trends still strong tailwinds?
Oh, absolutely. The broader market trends are incredibly supportive, like a massive tailwind, as you said. Gartner's projecting global IT spending to hit $5.61 trillion in 2025.
$5.61 trillion?
Yeah, up almost 10% from 2024. And within that, software is the star, expected to grow over 14% to $1.24 trillion. So the market ServiceNow plays in, it's huge and expanding rapidly.
And digital transformation is still a priority.
Top priority. For something like 74% of organizations globally, spending there is projected to hit $2.8 trillion by 2025. It's just not optional anymore for most businesses. It's essential. That's why companies keep investing, even when the economy feels uncertain.
Okay, that raises an important point, though. We hear a lot about higher interest rates potentially hurting growth stocks. How are SaaS valuations like ServiceNow's holding up?
It's a great question, and ServiceNow actually stands out here. You know the rule of 40.
Growth rate plus profit margin should be over 40. Right?
Exactly. Healthy SaaS companies aim for that. ServiceNow consistently surpasses it, putting them in that top tier. And yes, higher rates can pressure valuations by making future earnings less valuable today. But what we saw in Q2 2025 is that valuations for top-tier SaaS players, including ServiceNow, showed remarkable resilience.
So the strong fundamentals are outweighing the rate concerns.
It seems so. The market appears willing to pay a premium for companies demonstrating strong, profitable growth, efficient operations, and a compelling AI story. ServiceNow ticks those boxes.
Okay, that paints a pretty positive picture. But, every investment has risks. We have to look at the potential downsides. What are the key headwinds or risks that investors, especially here in the U.S., should be thinking about?
Definitely need to consider the risks. First off, the one everyone points to, valuation. It's high.
How high?
Well, as of late July 2025, the current PE ratio was around 125. Forward PE was about 48. Now, that's not crazy for a best-in-class growth stock, but it bakes in a lot of future growth.
So if they stumble or growth slows,
Exactly. If they fail to meet those high expectations, or if interest rates stay high for longer, that valuation could come under pressure. That's risk number one.
okay, what else?
Second, general macroeconomic uncertainty. Yes, global growth forecasts are a bit better for 25 and 26, but U.S. inflation looks sticky, likely staying above target. The Fed probably won't cut rates until March 26 at the earliest.
And that could impact IT budgets?
It could dampen overall enterprise IT spending, which is ServiceNow's bread and butter. So that's a risk. Third, intense competition. We can't ignore that.
Who are the main competitors we should watch?
Oh, it's the usual suspects, the giants. Microsoft with Dynamics 365 and Copilot AI, Salesforce with Customer 360 and Einstein AI, SAP, big in ERP with S/4HANA, Oracle with OCI Cloud and their ERP. Plus, you've got specialized players in ITSM, HR, CSM companies like Jira, Zendesk, Workday. It's a tough field.
It's a lot of big players vying for those IT dollars.
Absolutely. Fourth risk is AI execution. Their growth story heavily relies on delivering innovative, effective AI solutions. Any missteps in R&D or product rollout could hurt them badly in this fast-moving space.
Right, and data security, always a concern with cloud platforms.
That's the fifth risk. Data privacy and security. It's inherent in the SaaS model. A major breach would be catastrophic for trust and finances. And finally, number 6 is M&A integration risk.
They've been buying companies?
Yep. They just closed the Data.World acquisition in July 25, and they plan to buy MoveWorks later this year or early 26. Integrating acquisitions smoothly, realizing those synergies, it always carries risk. Could distract management or cause unforeseen issues.
Okay, that's a solid list of risks. Given that competition, especially from giants like Microsoft and Salesforce, how does ServiceNow really carve out its space and maintain its edge?
That really comes back to their unique selling proposition, that integrated platform.
The single platform again.
Yes. While competitors might have great point solutions, a fantastic CRM, maybe ServiceNow connects the dots across the entire enterprise. IT, HR, customer service, security, all on one platform. That creates synergies that are hard to replicate.
Breaking down those silos we talked about.
Exactly. And they position themselves not just as a system of record, like a traditional database or ERP that just stores info, but as a system of action. They focus on automating and executing the workflows, actually getting work done, not just tracking it. That's a key differentiator.
System of action. I like that.
Plus, their deep expertise, especially their origins in ITSM, gives them a strong foothold to land those initial deals and then expand across the organization. That land and expand motion is very effective for them.
Okay, so beyond the market position and strategy, what about ServiceNow's internal engine? What's going on under the hood that drives their success?
Internally, they have several core strengths. Innovation and R&D is huge for them. They spent, $2.73 billion on R&D in the last year, up over 15% year over year.
That's serious investment.
It shows their commitment, especially to leading in AI. And their platform architecture is built to support rapid development, letting them bring new solutions to market quickly.
And leadership.
Strong leadership and talent.
Yeah.
CEO Bill McDermott has a clear vision, very AI-focused, and they seem adept at attracting and keeping top talent in really competitive fields like AI and cloud engineering. That's crucial.
What about how they treat customers?
That's another key strength. Their customer-centric approach. Their focus on customer success directly leads to those high retention rates and the strong RPO we discussed. That land and expand strategy only works if customers are happy and seeing value.
Right.
They also build strong strategic partnerships. Think AWS, NVIDIA, EY, Visa. These extend their reach and capabilities. And finally, just solid financial management. They generate strong operating cash flow and free cash flow. And they use it wisely, reinvesting in R&D, making strategic acquisitions, and even buying back shares. They repurchased $361 million worth just last quarter. That financial discipline fuels growth without needing tons of external cash.
That's a robust internal picture. Now, for investors who like to look at charts, what's the technical picture for NW looking like right now?
Technically, as of late July 25, the picture is pretty positive. After that strong Q2 earnings report, the stock jumped significantly. It's trading well above both its 50-day moving average, which is around $999, and its 200-day moving average, around $951.
So the trend is clearly up.
The trend is clearly up. Momentum looks strong, too. The RSI, Relative Strength Index, is around 67. That's getting close to what some chartists call overbought, maybe suggesting a pause or might a pullback could happen short term.
Okay, potential consolidation.
Possibly. But, and this is important for a growth stock like ServiceNow, fundamentals often trump technicals. Big news AI breakthroughs, major contracts, another earnings beat that can easily override these indicators. The technicals are mostly reflecting the strong underlying business momentum right now.
Okay, so let's try and tie all these threads together. What's the consolidated view for American investors looking at ServiceNow today? What's the takeaway?
I think ServiceNow presents a really compelling case, especially for growth-focused investors here in the U.S.
Hmm.
It looks like a strong candidate for a core holding if you're fundamentally bullish on digital transformation and enterprise AI, which are, powerful long-term themes.
What are the main appeals summarized?
Market leadership in its core areas, that stable, predictable subscription model, really robust growth being fueled increasingly by AI, strong profitability, excellent cash flow, and, clear confidence from big institutional investors.
And for an investment strategy, buy and hold, watch certain things.
Definitely think long-term horizon here.
Hmm.
It's not a trade, it's an investment in a long-term trend. Key things to monitor. Keep watching that subscription revenue growth, especially the CRPO expansion. Track the adoption of their AI offerings. Hitting that $1 billion AI ACV target by 2026 would be huge.
Okay.
Also, watch how deeply customers are engaging. Are they signing bigger deals? Look for growth in those $5 million plus ACV customers. And of course, always keep one eye on the macro environment and the competitive chess game. Those external factors always matter.
It definitely seems ServiceNow is positioned right at the forefront, riding these huge waves of AI and digital transformation. Really fascinating how their strong fundamentals let them navigate even with broader economic questions out there. And as you think about all this, here's a final thought to chew on. With AI accelerating so quickly, could it actually change what we consider essential software? Could companies like ServiceNow become less cyclical, less sensitive to economic ups and downs, and more like, well, fundamental utilities for business survival in the future? Something to consider. Thanks for joining us for this deep dive.